Hello and welcome back. In today's video, I'm going to revisit the Tesla Yield Shares Purpose ETF with the ticker symbol YTSL. I had previously reviewed this ETF where I presented it as a very good alternative to the more popular Tesla ETF from YieldMax, and I still stand by that opinion because Tesla is mostly an income oriented ETF, whereas this ETF combines income and some growth as well. And so I'm going to do another comparison in this video where I will show how this ETF has performed in comparison to Tesla over the past 6 months. I'm also doing this update review partly because in the past month, the underlying holding for both YTSL and Tesla, which is the Tesla company, has performed really bad. In fact, if you look at its stock price, year to date, it is down over 25%. So I will also be sharing my overall views on the company itself and whether holding these ETFs is a good long-term strategy or not. So let's begin with the comparison. On the screen, we have a comparison of capital gains or losses made by the YTSL and TSLY ETFs in the past 6 months. I have also included the same figures for Tesla, the underlying holding, just to give a comparison of how the ETFs are performing in comparison to Tesla itself. Now, the numbers that you see on the screen represent the percentage difference between the stock price at the start of the month and the stock price at the end of the month. So, if the number at the end of the month is higher, we end up with a capital gain. If the number at the end of the month is lower than the number at the start of the month, then we end up with a capital loss. So there are a few observations we can make from this chart. The most obvious one being that YTSL is much better than Tesla at capturing the capital gains of the underlying holding Tesla. In fact, in the month of July and November, YTSL actually performed even better than Tesla. If we do the comparison, YTSL gained 3.13% and 20.71% in those months, as opposed to Tesla, which gained 2.16 and 19.54%. In case you're wondering why this happens, it is because YTSL holds actual Tesla shares and they also use a 25% leverage. Now, on the website, they have mentioned that they can write covered calls up to 50% of the holdings. My strong suspicion is that most of the time they end up writing covered calls on less than 25% of the holding, just because Tesla is a very volatile stock. So they are able to get the required income from the options premium by writing covered calls on a very small portion, which means that more than 100% of the holding is actually available to capture the capital gain whenever Tesla stock goes up. And that is why we end up with these numbers where YTSL is actually outperforming Tesla. But the reverse is also true when Tesla goes down, as we can see in the months of August, September, and October, where Tesla suffered losses and YTSL actually lost a higher percentage of capital compared to Tesla. This again happens because of the 25% leverage. So when Tesla goes down, YTSL not only captures that downward movement in Tesla, but it does so with an additional 25%, which results in higher losses. Of course, some of that loss is offset by the income this ETF generates. And that is true for Tesla as well. A lot of the capital loss that we see for Tesla is offset by the high income it pays out. And I understand that the numbers look really bad, especially in the month of November, where Tesla went up by almost 20%, but Tesla gained only 5%. But we must also understand that these numbers only represent the capital gains for these ETFs and do not include the income that they pay out, which would give us the total return for the ETF, and which I believe will be a more fair comparison with the total capital gain loss for Tesla. because in case of Tesla, there is no additional income or dividend being paid out. So the capital gains or loss for Tesla represents its total return. But that is not the case with the ETFs. So on the screen, I will now show you the total return of YTSL and TSLY in the past 6 months when we add in the income that they paid out. So, over the past 6 months, YTSL paid out approximately $2.16, and this amount is in Canadian dollars, which gives us a total return of negative 4.47% in the past 6 months. On the other hand, TSLY paid out approximately $4.25, which is in the US dollars, and that gives us a total return negative 5.67%. And when we really compare these returns to the total return of Tesla, they are almost identical. In fact, YTSL actually outperformed Tesla. But even in case of Tesla, the underperformance is not as significant as it appears to be when we only look at the capital loss. Now, what does this really mean for us as investors? Since the total return of these ETFs is almost identical to that of Tesla, would it not make sense to directly hold the Tesla stock rather than going through the hoops of writing covered calls and generating some income, only to have the total return identical to the actual stock? Well, one way to look at this is that these ETFs are designed for people seeking income. You know, money today is more valuable than money tomorrow. Having that income right now might be more useful for some people, may not be for all, but for some people it might be more useful to have that income right now. And obviously, they are generating that income using covered calls, but what they're really doing is that they are giving us a steady flow of monthly income, which ideally would not be possible or would be quite a difficult decision making on part of an individual person if that person is only holding Tesla stock. So someone might say that, I can replicate this by simply holding Tesla shares in my account and selling some portion of that share as monthly income. But imagine what would happen like right now, where in the month of January the stock has gone downhill. Would you as an individual take it upon yourself to make that decision? What would be the best price to sell the shares to get that monthly income? Or would you say, no, let me wait, let me think about it? So, when you're trying to replicate something like that individually, the decision making becomes a little more difficult. So, these ETFs, in a way, are also providing that service where they're doing that decision making for us and giving us that steady flow of income. And we don't have to worry about the decision making of when to write the calls or when to sell an individual share to replicate that monthly income strategy. At the same time, the fact that YTSL managed to outperform Tesla, even though by a small margin, it was able to do that during a time period where Tesla's stock has just moved sideways. Now, I want you to imagine what would happen during a bullish market where Tesla stock goes up for 6 straight months. During such a market, I expect that YTSL would outperform Tesla by an even bigger margin because it would most likely match the capital gains return from the Tesla stock during those 6 months, and in addition, then provide the income. So the total return for YTSL might end up being around 10 to 15% higher than Tesla during a bullish market. And I actually hold only YTSL, I do not hold Tesla for this very reason, because I expect Tesla at best could match Tesla or underperform Tesla. But YTSL actually has the potential to outperform Tesla on a consistent basis. And holding Tesla also does not make any sense, especially for those in Canada, because you would end up paying the 15% withholding tax, which would pretty much guarantee that you underperform the underlying holding of Tesla. Last but not the least, I want to highlight the Tesla stock itself. What is exactly happening with this stock? Let's be honest, the year 2024 so far has been a bumpy ride for the stock, and it has mainly happened for two reasons. Number one, in the most recent earning calls, Tesla provided a very poor guidance regarding its future growth, where it is expected that the growth would slow down. And number two, the court case between Elon Musk and the shareholders, where the court denied Elon Musk a $56 billion payout. Now, if you really think about it, neither of these two reasons should really be a cause for worry because they do not have any major impact on the long term viability of the company. For example, the most recent earnings call also emphasizes that the company is focused on developing new technologies such as the Optimus robot, which would add new revenue options for the company, which in turn would actually cause the company's growth in the future years. So, yes, maybe in the next 12 months, the company is not expected to grow, but after that, growth is possible. And as far as the Delaware court case involving Elon Musk is concerned, some people were speculating that Elon Musk might do something rash after the ruling went against him, such as selling out his entire stake in Tesla and just concentrating on other projects. But in reality, the only action that Elon Musk has taken is to reincorporate the company in Texas, which I believe is probably a good decision. But either ways, this ruling again won't have any major impact on the long-term profitability of Tesla itself. So, in both cases, it is nothing long-term. It is just short-term speculation that is driving the stock price down. And in such cases, I would say it's time to buy. But again, that's just my opinion. And that does bring us to the end of the video as well. So, like always, make sure to do your own due diligence before making any purchase decision. All the opinions and predictions that I've shared in this video are just my opinions based on my calculations and the information that I've presented to you in this video. If you found some value in this video, don't forget to like, share, and subscribe. And I'll see you guys in the next one. Thanks for watching.